RV market just fell off a cliff. Sales are down nearly 50% from their peak, used prices have dropped by 25%, and manufacturers are bleeding. For a lot of people, this is just another quirky pandemic trend that reversed. But what if I told you the RV crash is a canary in the coal mine for the broader economy? This isn't just a niche market wobble. RVs are a textbook example of how the American consumer operates when times are good. Cheap credit, aspirational spending, and a splash of YOLO. But right now, none of that's working. Demand has dried up completely. Financing is getting expensive. And the people who bought in at the top, they're finding out what depreciation really feels like. Let's start with the basics. In 2021, over 600,000 RVs were shipped in the US, a record-breaking number. But as of the end of 2024, that number was slashed in half. And according to the RV Industry Association, shipments in early 2025 are still below historical averages. It's not a return to normal, it's a hard correction. And if you look back in time, the last time RV shipments fell this dramatically was in 2007. Back then they dipped by 30%, right before the housing collapse. Not coincidentally, RV sales tend to tank before major recessions. They're one of the first things that people cut when uncertainty hits, and historically, they've been a strong leading indicator of economic slowdowns. Why? Because buying an RV is a luxury decision that requires two things: confidence and credit. Most RV buyers finance their purchases, and around 70% of RVs are bought with loans. The average down payment is just 10 to 15%, and many people stretch that loan out over 10 or 20 years even, just to keep the monthly payments low. It's not uncommon to see payments ranging from $400 to $1,200 a month, depending on the model and the loan terms. And that's before you get into storage, maintenance, insurance, and fuel costs. So when rates hit 7%, 8%, or even 9%, you're not just buying a toy, you're taking on a second mortgage. Right now, a new fifth wheel RV could cost $80,000. It would run you over $1,000 a month. And if you bought it in 2021, you probably overpaid and locked in a loan at a lower rate. But now if you want to refinance or sell, you're underwater. RV values, they've dropped. And because they depreciate faster than cars, it's not uncommon to owe more than it's worth on your loan. Reddit is full of horror stories. People bought RVs during the pandemic thinking that they would travel the country and live cheaply, or maybe even retire early, the FIRE movement. But now they're stuck. They can't sell because the loan balance is higher than things worth. They can't refinance because the rates are up. And they don't want to keep throwing money at something that just sits in storage and a lot for half the year. This is how bubbles end. Not with a bang, but with regret, monthly payments, and a Craigslist listing that gets no clicks. And RVs are not the only asset class going through this right now. You can throw boats into the same bucket. Boat sales boomed during the pandemic too. Families thought, if I can't go on vacation, I'll bring the vacation to the lake. Boat dealerships saw record sales in 2020 and 2021. But now, inventory's stacking up. Used prices are falling. And marina storage lots are full of vessels that no one wants to pay to maintain. Jet skis? Same story. These are high maintenance machines with seasonal use at best and a short thrill lifespan. Dealers are cutting prices to move inventory, and used markets are really soft right now. Insurance, maintenance, fuel, all of it, they just add up. These are purchases that people justify when times are good, when bonuses are fat and rates are low. Today, that equation just no longer works. Even golf carts, believe it or not, they've become part of the pandemic asset boom. In suburban and retirement communities, custom golf carts turn into luxury status symbols. Bluetooth speakers, custom paint, lifted suspension. People were spending $10,000 to $15,000 on souped up golf carts like they were mini Teslas. But now, the market is saturated. The novelty's worn off. And listings, they're piling up all over Facebook Marketplace and Craigslist. And then there's collectibles, trading cards like Pokemon cards, comic books, luxury watches, think Rolex, you name it. During lockdown, prices exploded. Everyone was home, everyone was bored, and stimulus checks, they were landing in bank accounts. So people started buying stuff they thought would go up in value forever. A Charizard card sold for hundreds of thousands of dollars. PSA couldn't grade fast enough. But now, the volume has dried up. Prices are falling, and people are realizing that speculative bubbles can happen in cardboard too. Rolex watches followed a similar arc in 2021. The secondary market prices hit record highs. Dealers had waiting lists. Resellers flipped models for $5,000 to $10,000 in profit overnight. But today, the froth is gone. Prices are down 25 to 30% across the board. Even Rolex Daytona models, once impossible to find, are now sitting unsold in cases. If you walk into a dealer in 2025, they actually have inventory, which if you've ever tried to buy a Rolex before, that's not normal. Imagine that. And then again, it's not just about toys. It's about liquidity. It's about credit and the consumer psyche. When easy money floods the system, people reach for luxuries. But when inflation eats their paycheck and their lunch and rates spike, then the debt piles up and those luxuries are the first to go. What ties all these markets together, RVs, boats, watches, collectibles, is that they all soared when people had nowhere to spend and they were stuck at home. But now that reality's returned, so has price discovery. And for most of these pandemic darlings, the discovery is brutal. It also tells us something deeper about the US economy in 2025. Beneath the headlines, beneath the official employment data, we're seeing a shift in how people live, what they value, and more importantly, what they're actually willing or able to finance. This is why the RV crash is not some isolated, weird niche event that doesn't affect most people. It's a flashing red light. It's telling us what the official numbers will not admit. Consumer demand is softening, credit is tightening, and discretionary income is gone. And yes, long term, maybe RVs bounce back. Boomers are retiring, Gen Xers are aging into travel-friendly life stages, but the question is not whether RVs will sell again. The question is what this crash says about now. Because when Americans are unloading RVs, listing boats that they've never used, selling watches that they bought at the top, and trying to refinance loans they never should have taken out in the first place, that's not strong consumer health. That's a warning. So, if you're looking for signals of an economic slowdown, don't just watch the stock market. Look at the real economy, RV sales, boat repossessions, Rolex inventories, sports card auctions, and in below reserve. These are the cracks. This is also a psychological side to all of this. People aren't just losing money, they're losing confidence. When someone buys an RV or a boat, they imagine freedom, adventure, quality time with the family. When that purchase becomes a financial burden or a bad investment, it changes their behavior. They start hesitating before spending on other big ticket items. That hesitation multiplied across millions of households is how recessions quietly begin. Confidence erodes, spending slows, and suddenly the economy feels a lot colder than the headlines might suggest. And then there's the local impact. RV dealerships, repair shops, and parts suppliers, they all grew rapidly during the boom. Some even expanded locations, hired aggressively, and even took on some debt assuming demand would stay elevated or to continue to grow. But now that the wave has crashed, many are left way overextended. Layoffs have started. Inventories are starting to be discounted. And in smaller towns where RV sales are a big part of the economy, the effect's not just visible, they're also painful. This is happening against a backdrop of rising consumer debt. Credit card balances in the US just crossed $1.3 trillion. Auto loan delinquencies are spiking. And now we're seeing the cracks even in safe assets like RV loans and recreational financing. The typical RV buyer is not the same reckless spender. They're middle class usually, often retired, and they're used to budgeting. So when that demographic starts defaulting, you know something deeper is wrong. The next 6 to 12 months will be crucial. If the Fed cuts rates aggressively, we might see some temporary relief if it makes it all the way down to consumers, but lower rates won't undo the structural problems. The affordability crisis, the debt overhang, and the fragile confidence, those will remain. What the RV market is showing us is not just a blip. It's the front end of a correction, and it's a reminder that eventually, reality does always catch up. The RV crash is not just about travel trailers. It's about overstretched consumers, delayed consequences, and a country learning that maybe lower interest rates were not permanent after all. And that might be the most honest economic indicator that we've got. Anyway, thank you so much for watching. If you enjoyed this video, please give it a like, subscribe for the YouTube algorithm, and leave a comment down below telling me if you or anyone you know bought an RV during the pandemic and if they're regretting that decision or if they're happy with it. Thank you so much for watching, and I'll see you next time.